Hi, hi, ladies. I'm Charlie. Today we are having a discussion about passing the torch. What family businesses need to know about ownership transfer. So we have today sharing with us Miriam and Chitali with their areas of specialty, and I'll give each of them 30 seconds to introduce themselves. So Miriam, may you start.
Hi, thank you for having me, Cardine. I really appreciate it. So my name is Miriam. I'm a business and estate lawyer. I also have a strong focus on employment law, and I used to be a former litigator on top of that. So I used to practice in estate litigation and basically building businesses and creating legacy planning for my clients. So I do.
Chitali?
Hi everyone, thanks Cardin for inviting me today. It's a very beautiful day. I am an accountant. I have been doing accounting since about 12 years. I am a founder of accounting firm Chitali Patel Professional Corporation, and I specialize in proactive approach to helping business owners plan their finances, and ultimate goal is to have those happy tax returns at the end of the year. Overall, big picture services that I offer, I help out with the personal taxes, corporate taxes, audited statements, financial reporting, budgeting, help plan out so that you can meet your business goals.
Awesome. And of course, myself, Cardine Williams, I'm also a CPA and an insurance strategist. So I will help you protect your business through each stage of its growth. So let's dive into the case study. So today we have this fictitious case, Legacy Woodwork Inc., and we are going to give some basic information. I say basic because I want you to learn as much as you can today, but also know that you should talk to your specialist, your professional advisor, lawyer, accountant, insurance agent to flesh out the strategy that best suits you. So for Legacy Woodwork Inc., it's a family-owned furniture manufacturing company in existence for over 25 years, led by the parents David and Patricia, and they have kids, Michael and Rachel, coming into the business. David and Patricia they're in their 60s, and they're looking to exit the business in the next 5 years, and their kids will take over ownership. So guess what? We're going to dive into the different facets of legal, accounting, and risk management over the inception, maturity, and exit ownership transfer of a similar corporation. So let's start off with the very first thing that we need to do, starting the corporation. So Miriam, what are some of the things that should be considered by individuals going into business, wanting to incorporate?
So thank you, Cardine. So the first thing I do is I create a legal audit of the corporation. So what I want to know is how the business structure is designed. So I'm glad that they're incorporated. They've been in business for 25 years. So my first thing is to do some corporate housekeeping. So I would go through the minute book. Now, a few people don't have a minute book. They think it's, just a luxury, so to speak, but it's actually a legal requirement, compliance, to have a corporation. So if you don't have a minute book, please go to a lawyer and make sure you have that sorted out. So what is a minute book? It has the articles of incorporation, it has the share certificates, the bylaws, everything, the directors, all of that, right? It basically proves the ownership and decision-making authority of your corporation and the shares that are executed and all of that, right? So that's what needs to be done first. We need to make sure that the minute book is up to date and what the records look like. Now, in terms of discussing about share structures, I would also want to see, for example, the parents, if they have David and Patricia, if they have common shares. And then if we're going to bring the kids to join on, what is that going to look like? Would that be typically non-voting shares, right? So we would talk about that. Parents usually want to kind of, have their kids slowly into the corporation so they can get an idea. And so maybe they'll put the kids as directors or officers just to get a feel of the managerial roles in the corporation. So that's one way of doing that as well. So again, we would also speak on discussing shareholder agreements and buy and sell agreements, which I'll delve into the second phase a little bit more, but that is something the conversations need to start, right? So they're not retiring just yet. They still have 5 years, but it's all about the conversations and how they want to move forward with it, right? And then something really important as well that people overlook is the power of attorney that they wills, right? So we need to take a look at the wills, especially if you have a corporation. We would recommend a secondary will, or we call it corporate will. And what that is, it avoids probate tax, or reduces probate tax, so your shares aren't actually evaluated at probate. So it's a lot of money saved there. So we would look at that. But in addition, the power of attorneys for property and personal care, God forbid something happens, can the kids step in on their parents' behalf and manage the business? Do they have authority to do everything that they need to do except make a will for the corporation? What are the key factors in place that needs to be put in writing, or to at least be understood? So these are the discussions that need to be had, right? And of course, I mentioned a little bit about the buy-sell provision. I'll just touch on that a little bit more in this phase. So for instance, I'll give you questions like, what happens if one person wants to leave the corporation, or they pass away, or who's going to get the shares? How are they going to get the shares? What are the shares valued at? Things like that of the sort. Another big change would be a divorce. What if one of the children gets a divorce? How does that affect their stake in the company, things of that nature? So it's basically providing a business plan for their retirement and then after, right? How are things going to be administered after the fact? So these are very important things. Triggers: death, disability, retirement, divorce, dispute resolution, because what if one kid wants to continue and the other doesn't, or they are continuing together and they have a difference of opinion? It becomes a matter of issue and contention among the parties, right? So that's basically what we would discuss. It's all about managing expectations at first and thinking of all the little scenarios and what is supposed to be done, or what they prefer to be done, and having that understanding, so later on it's minimizes the issues, if you will. Sometimes people change their minds. So that's what I would say in the first initial phase is what we would do with the audit when it comes to transferring.
Yeah, and
transferring.
Just to clarify, you've mentioned a few things there. The shareholders agreement was one of the key things, the POAs, wills. At what stage in the business would you think it would be best to have these documents done?
Well, typically a shareholder agreement is a more broader governing document as to who is supposed to do what, who is the signing authority, in addition to more clauses around triggers around exit, and making sure that shares aren't there's first right or first right of refusal clauses, the shotgun clause, whatever the case is, whatever they've agreed to, right? So I would always say, once you incorporate, always have something like that in place. The buy-sell agreement, it could be part of the shareholder agreement. It could be both that you have in place, but the buy-sell agreement, is very specific to what is going to happen in terms of your exit, how it's valued, all of that. So it's very, very specific in that regard. In this case, I would say more of the buy-sell agreement would be sufficient, but you could still also have a shareholder agreement. You could do it as early as you incorporate, but at this point, since we're now just having discussions about the kids joining on as directors and officers, and to slowly have that transition, I would say you start to have those conversations and perhaps start drafting, speaking with an accountant as to how that would work out and what those questions are. So there's also things around whether you want to freeze the shares in the buy-sell agreement, if you want to change to preferred share, whatever the case is, it's all about the tax planning aspect of that, and the buy-sell agreement will reflect that, right? So that would be at that point.
Okay, so Shatali, what are you thinking?
Lots of
coming
things.
out of Miriam.
Really,
really
good.
A lot, eh?
Really good start off. So definitely, I am really glad you mentioned about the minute book, and we see this almost daily, right? Because when companies are incorporated, in order to actually get that business number or the incorporation number, the actual incorporation process does not mandate, right? They can still incorporate, but then often there are many times that minute books is skipped. But it is very critical. And coming down to minute books, so you touched on a few points very critical. One thing I would go back to is that from accounting perspective is that when you think of the share structure, you want to, so there are two types of shares, very basic, authorized and issued. The authorized shares basically means that the company is authorized to issue those type of shares: class A common shares, class B common shares, pref shares, different categories, right? And there are voting rights, non-voting rights to give you control or not to give you control. The issued is your company is authorized and you issue only certain shares to in order to make that person an owner of the company in very basic manner. So from accounting perspective, it is recommended that you at least authorize, when you incorporate, you at least authorize some different classes of shares, including some pref shares. So down the road, for certain tax planning perspective, for example, estate freeze, your company needs to have those authorized pref shares. If you don't have those, then you cannot issue any of the pref shares. So that's something to consider. And when you are actually issuing shares, something to think about is that there, in this case study as well, there are two owners, the two parents, right? Consider if you want to issue shares out of the same class or different class. If there are shares owned from different classes, you can actually distribute dividend at different amounts. So that every year that gives you an opportunity that with higher level of income, maybe they are earning income from some other sources other than the business as well. So on their personal taxes, you have that flexibility to issue more or less of the income to individual, and there is an opportunity to split the income accordingly. But if you have shares issued only from the same class, then you are limited to issuing dividend to both of them in the same amount. So there is less flexibility. So these are some of the things you would want to consider when you incorporate at the very initial stage.
Great. Thank you so much to both of you. And I think why this conversation is so relevant is that 63% of Canadian small businesses are family owned. And that's why we've tailored this case study to address the majority group. And you both have mentioned a few documents. In particular, Miriam, you mentioned the shareholders agreement and the buy-sell clause. There are a number of points in the business that could trigger the need for funding, right? You mentioned the buy-sell clause, exiting the business, whether it be by death, disability, critical illness, or even retirement, right? So I've read that the buy-sell clause is worthless if it's not funded. And that's where I come in, making sure that the business has cash when these instances happen. It's important for business continuity, right? Making sure that if something happens, if the owner passes, how will the business continue? How will the families that depend on it continue? We have key decision makers in the business. Yes, we've named the parents, but they might have key persons alongside in the business that helps them to build it, right? What happens to the business if these persons are no longer capable, right? It might impact revenue. So certain safeguards need to be built into the business to ensure that if these instances happen, the wishes outlined or the steps outlined in the shareholders agreement, in the buy-sell agreement, can actually be actioned, right? And making sure you have these tools, life insurance, CI, disability insurance, in place to ensure that you're able to do that, right? And for a young business, typically, owners they want cash. Money is always a concern, right? They want money. And they typically have to go outside to source that funding. from banks, other lenders, and so forth. And they also have to offer personal guarantees, right? And in that instance, it could be detrimental to the business if they do not have these safeguards in place to ensure that money comes into the business triggered by the instance of disability, a critical illness, or even death, to make sure that those corporate liabilities are covered, right? So there are a number of things that needs to be built into the shareholders agreement, the buy-sell clauses, and inside the financial infrastructure of that business, right?
Mhm.
So David and Patricia, they spent decades building this business, right? So
Mhm.
I know at the inception, cash can be tight, right? Resources need to be leveraged, etc. But as the business matures, the dependency on cash, external cash, might be relieved. Maybe they're building up retained earnings and so forth. So, what are some of the additional concerns when a business gets to the point of maturity that, from a legal perspective or an accounting perspective, they should consider?
So I think, let's say like we're into, I don't know, year 3, year 4, right? And at this point, I would suggest to the client, okay, what are your goals now? What's going on? What is your cash situation? Excuse me. In a shareholder agreement, even with that, you can put out certain terms, like a payment plan, if you will, if it's going to ease it for the clients or for the kids, whatever the case is. But you would have to now revisit what the goals are, make sure everything is aligned, and again, have those conversations because the business has now grown. In addition, a formal succession plan should definitely now be essentially finalized, right, and agreed upon by all parties, so there's no surprises. The more things are documented and the more things are understood and the discussions are there, the less surprises in the end. Something that people don't consider, especially in family-owned businesses, is the intellectual property of the business. It's the contracts, the assets, the leases. What is going to happen with all these things? Again, this needs to be formalized in an agreement, and how that's going to transfer over should the kids actually intend to keep the business and continue the business, or if they want to sell it, what would that look like? What would they need to do? So it's those little things that tend to be overlooked because they think that, okay, we've already had the discussion in the initial phase, we've got some documents drafted by the lawyer, and we've spoken to the accountant, but it's been a few years in and things do change and situations do change and people don't change. It could be that, I don't know, all of a sudden, what was the gentleman's name? It's not David, it's Michael. Michael does not want to participate whatsoever. He has an issue with Patricia and they just cannot be on board and running the business. So how are we going to figure out the dispute resolution? How are we going to, if they do take over in terms of their shares, can he buy her out? Like what that looks like, things like that. Or maybe they just have different roles and they're just in charge of different things. Again, that's when the shareholder agreement comes in, where it governs and it speaks to what each person's role and responsibility is. Again, the more clarity on that, there should be less contention, right? So it's just about revisiting at this point and making sure that the assets are also protected. Now, something, I'll just touch on it. It's optional. It's not a requirement, but I do advise on it, where it could be that you set up a holding company to the operating company. And again, that's just for legal protection. It's for dividends, for all of those things. It's easier to transfer assets also with this state if there's a holding company in place as well. So that is something to also consider, and I would also recommend that it be set up at this stage. Since there's all these changes being made anyways, might as well add a holding company for the operating company as well. So that's what I would say at that point.
How about you, Shatali?
Yeah. So as the business matures, that's where you really there are a lot of things going on, and things to, well, the business owners. This is what we have seen often. Business owners, while they are so much busy in building their own business and they are so much involved in operations, that some of these things slips off, right? And the time is really critical. It may sound like that in 3 years or maybe 5 years we're talking about success and planning, but yes, it is very critical for how long it takes, right? And sometimes we need to apply those strategies early on. During this period, from accounting perspective, two things you really want to have your eyes on and be clear with is the balance of retained earnings and the shareholder loan account. Shareholder loan account is something where practically, specifically when you have so many transactions between company and your personal account, it is very critical to track it properly, because if you have withdrawn so much of the fund from business, you would be taxed on it through dividend, or otherwise if you have or vice versa, right? There could be possibility you could also withdraw money tax free. So that's very critical. Down the road, also from planning for exit, there are a few things. There is something called, at the end of coming down to basics, what happens when you either sell or transfer the shares, right? At the end, the shares are considered property from tax perspective. So when you sell any property, it triggers capital gain, which is basically the value of that property when you do actually sell, less the cost. Now the cost, when you incorporate it, if you have seen your minute books, oftentimes it's $1 per share, or maybe 10 or 100. So it's minimum. And when you have developed your business, the value of the shares would have been much higher, right? So because the value has grown, your business is doing great. The difference between is often so high that it's very critical to the difference between the two is called the capital gain, and there would be tax on half of the capital gain in 2025. There are some rules coming up in next year where the inclusion rates are going higher as well. Anyways, but they're taxed on. So that's where tax planning strategy should come in, where there are a couple things. There is one thing called lifetime capital gain exemption. Every person, when they sell some qualified shares, they get exemption from the capital gain, and there is a limit. It changes every year, so it is good to get information from your accountant when you're actually planning around. Why we need to think about lifetime capital gain exemption ahead of the time? Two things. It's not only for your shares. If you have owned shares or qualified property otherwise than this business, and if you have used a portion of the lifetime capital gain there upon selling, you would be left with only remaining limit, right? So keeping track is important. Also, I mentioned about qualified shares. So you want to make sure your business, the shares of your business fall into that qualified shares, and therefore you want to, as your business, the scenario of your business changes, you want to check it with your accountant to make sure that this can still be applicable in every year. The other things are, you may want to consider about the estate freeze. You may have heard about it. It's essentially freezing the value of your shares, so to help defer your gain in the future. It is a little bit more complex topic, but that's another strategy that you could use. And this is, as you are maturing in your business, that would be the best time to talk to your accountant about exit plans. And these are the couple names that I have mentioned, but the timing is very critical. I cannot stress enough there.
Awesome. Thank you, ladies, for all of that information. And you mentioned a few things. Now we're looking at intergenerational planning, right? You mentioned the cash reserve. Maybe now they're building cash reserves and they have this cash being kind of stuck in retained earnings. Businesses might now be thinking about what kind of opportunities are there for us to get cash out of the business and have that build somewhere tax efficiently. And that's where I can help them with that, giving them a tool, a vehicle that they can use to amass wealth, still using that retained cash in that business and have that grow tax efficiently. There are various reasons why they'll want to use a tool like cash value life insurance. And that could be their retirement planning as well, right? Because for small businesses, they need to create their own retirement plans. And this is a way that owners can create a retirement plan for themselves. This is a way that they can create retirement plans for their key people as well, by building that asset inside of a policy that they can leverage to fund their retirement. These policies are, of course, corporately owned, corporately paid for against, but the insured is the individual, right? So this can be structured in that way. And again, no matter the size or the stage of the business, look at your balance sheet. If you have a high level of corporate liability, you need insurance. You have key people, how will they impact the continued growth? How will your business be sustained if something happens to them? You want to make sure that you have funding that comes into the business to help you go through these periods, right? Whether it be onboarding, recruiting, training, getting a consultant in when somebody, a key decision maker, is incapable of contributing further to the business. There are other things that you want to look into. Expansion. At maturity, when businesses have this reserve, they're growing, they might be looking towards expansion. Typically, if you go to a traditional funding source, guess what? You need a lot of documentation, right? But over time, instead or alongside that, you can build a reserve that you can easily access to pursue opportunities. And this is what you can use the insurance product to do. People don't know that in corporate, right, these tools are available as well to manage, to help with liquidity, to help with forward planning, succession planning, also retirement planning. So these are things that you can look at. You mentioned the holding company. This is a good strategy, especially when you're looking to transfer the business, because the ratio of active to passive income will impact the transfer process. Because Chitali, I don't know if you can speak to this in more detail or if you plan to, but the purification process for your balance sheet, right? So moving passive assets to a holding company puts the operating company in a better position for transfer of ownership as well, right? So definitely important points that you've made. So now that we are looking at maturity, the next phase is the point of ownership transfer. So these parents, they're looking at their kids, they've built this company, they're proud of it, and they say, hey, you guys, you've been working in our business since you were teenagers, now it's your turn to run the show, right? So maybe these kids, maybe they don't have the money to purchase one shot, right? Irregardless of who it's being sold to, we know our government wants their share, right? It will be a fair market value. And this is another reason why insurance is so important, supporting that buy-sell agreement. If something happens to either of the owners at this point in time, the other owner under the buy-sell agreement might want to buy out their portion of the assets. Where is that money going to come from, right? Money can come to them tax-free and in lump sum to assist with this, right? So it facilitates the easy transfer of ownership and the smooth transition of the business. So who feels safe in a scenario like this? The owner feels safe because you know where the money is coming from, and your team feels safe, right? All the families that depend on the business, they're in a more secure position because we have these strategies in place to ensure the business has funding when they need it most, right? So ownership transfer, we're at this final stage. The parents are ready to exit. They're tired. They want to go cruising in the near future. What could be potential steps that they could take? I know, Shitali, you mentioned a few things already. The different classes of shares that will allow them to transfer ownership. Maybe shed some more light on that phase.
Yeah. So consider, for example, in the beginning when you were incorporating, you weren't thinking this far, or you didn't have that right advice, and you didn't have pref shares authorized, or well, you're not stuck. You can still correct me if I'm wrong, Mariam, but you can still authorize new shares, right, in the company. So that's an option. However, it is still recommended when you incorporate it, it is done properly, so that whenever you're ready, these things are not delaying you, right? So that's one thing, Mariam, Karin, that we touched on, the type of shares. When you are ready for actually with the exit plan, critical, and I mentioned it before too, the actual transaction would be much smooth if it is planned well. Yeah. Right? It's matter of, specifically from accounting perspective, it's matter of at this stage to do it properly, so that all the reportings are done well. That's where it's not, at this point we are not thinking of okay how. It's matter of getting those final documentations ready. This is where it's very important that when we have seen some cases when if the planning was not done or not done properly, this is where we lose an opportunity, and we are sitting in the chair and we are like, okay, what are our options? Because we would be limited, right? Estate freeze, for example, if you haven't done that freeze a few years back, like if you have done that estate freeze now, and if you're selling or transferring shares next year, it wouldn't give you as much of a benefit, because the value of your shares wouldn't have gone up that much, right? There isn't been that enough of the time period, right? Mm-hmm. So many of the strategies we would need to plan ahead. The other thing, shareholder loan account, again, that's something you should track it every year to determine your dividend. And another thing, income splitting, I would stress and remind about the TOSI, tax on split income, so that not that all the owners are, that TOSI is basically a rule from CRA, a tax rule, tax on split income. If one of the owners is inactive, this is on a big general perspective. If one of the owner is not as much active in business, they may not, that there might be a tax on split income. And there are so many detailed criteria. So it is very important when, even during the exit plan, that you are safe from those additional taxes.
That's a good point, Chitali. When you're planning your exit, whatever the exit may be, right? Because some exits are voluntary and some exits are forced. So whatever the exit could be, you need to plan for it. If you're planning to retire out of your business and pass it to your kids, plan 10, 15, 20 years in advance, because you need to be planning for funding that retirement for 10, 20, 30 years ahead, right? After retirement, post-retirement. If you're planning to sell the business or even exit to your kids, whichever, you know you have a capital gains bill to plan for. So plan it. If you need to structure your balance sheet in a certain way to allow an efficient transfer, plan that, because everything does take time to set in place. And as you said, there is flexibility in the shareholders agreement. There's flexibility in your funding sources as well. And this needs to be revisited regularly, so you can make adjustments as necessary as your business changes, as your outlook changes. You mentioned a scenario, Miriam, where maybe Michael wants to leave the business. Maybe he's going through a midlife crisis and he wants to go sail around the world, right? And he wants to leave the business.
Happens.
Exactly, it does happen. He wants to leave the business, then Rachel needs to be in a position to buy him out, right? So you do need to plan for all of these eventualities. So from a legal perspective, Miriam, when it comes to that transfer of ownership, what should they be thinking? What T's should they be crossing? What I should be dotting?
Well, at this point, when the transition's about to happen, we're very hopeful that the discussions have been extensive and everything has been documented. So it's just a matter of now extra paperwork to actually do the share transfer, to actually have the resignation of David and Patricia, et cetera, et cetera. Something to revisit as well, because you brought up Michael. Another thing, it could be that Patricia got married and now she's going through divorce, or she's not going through divorce, rather she's passed away and she has a spouse. There should be some family law provisions in the shareholder agreement to protect the shares as well, because the last thing I think Michael would want is to be dealing with her spouse has ownership of the company, et cetera, et cetera. There has to be provisions in there. So it's always a conversation. You're always supposed to, every few years, amend the documents, revise them, see what the situations are. I like to the best of your ability, try to think of as many possible situations you can to make sure you have guidelines as to what needs to be done. But at this point, when they do come to retire, it should more, I don't say set and done, but take another look at it, review at the insurance policies as well, see how that fits in and how the buyouts are going to happen and how that's triggered, et cetera, et cetera. So again, it was just to make the actual transfer, you would just go to a lawyer and they would basically rely on the documents that you've signed off on, that all the parties signed off on, and just we're hopeful that everybody's agreeable to it, that not too much has changed, because it's been consistently amended when the changes have been happening. So again, it would just be the share of transfer documents. You have to update the minute book, of course, if they've resigned, and make sure that you are implementing the correct policies in place, the clauses in the buy-sell agreement or the shareholder agreement, right? So those mechanisms are now in place, and that's what's going to guide the smooth transition, right? So that's what I would say to that. So, if you don't put it in and you don't speak about it, and you just kind of leave everything out into the ether, there can be conflict that comes up. So it's always best to prepare and plan as early as possible, when life changes happen and onwards, until the actual transfer of it. So I just want to say to that.
Actually, yeah, you mentioned it very well, and I cannot stress enough. I mean, revisiting from start early and then revisit often. From tax perspective, from tax perspective as well, rules changes. Some example I mentioned about TOSI, that's not too old. I mean, that came in few years back, right? Like, that was a new concept. Capital gain inclusion rate, right? Just recently that increased. So does your plan, like, we would have done all great strategy from legal perspective, we would have a package with legal perspective, the funding, insurance, and also from tax saving perspective. But if the rules changes, or even for better, maybe more options available from an insurance perspective as well, right? So revisiting every few years, that's very important. Or if you hear a news or anything about the changes, go visit your lawyer, all your point of contact, right? Accountant, your insurance agents, or financial strategists, to see if you're still in a good position, right?
Yes, I agree with that. Yeah, if I may, I think Charlie and I were speaking prior to this, and I was mentioning a lot of clients, they might put certain mechanisms in place, like they might have the agreement in place, they might have some insurance in place, they'll speak to an accountant and set up the structures. But in terms of the final goal of what they actually want for their business or for their kids, it seems to be incongruent, because nobody's talking to each other. So I would always recommend that when you do set these parameters in place, that you have almost like a little business advisory club, if you will, right? A group. So, you have your lawyer, you have your accountant, and you have your insurance strategist, and they're all talking to each other when you're making these changes, because the law does change. Account taxes always is changing. We all know that. And we can't be held responsible. It's your responsibility to make sure that you are constantly checking in and making sure that everything is going to hold, and that you were in compliance with the law at the time, right? That's now, that's now been amended, if you will, right? So that is your responsibility to do that, and to make sure that your people, your business advisors, are all in it together to have the holistic approach of what exactly do you want, to make sure that it's a seamless transition, right? So I think, some people, they put things in place, but they're not really sure how they work together. And so unless you have all parties hop on a call like this and they get the full picture, you should be more confident to make sure that the transition from the business to shares, your kids, whatever the case is, it will be okay. Like you're protected in that way. So that would be my recommendation.
Great. And you know what? With proper planning, nothing will catch you. Well, maybe it will catch you by surprise, but it won't catch you unprepared, right? So that's the goal, to be prepared for whatever scenario plays out. Whether everything goes as planned, right? You build a fantastic business, your kids are happy participating in it, you're healthy, you're well, you retire, you go have your fun, right? Or you also plan for what if life is short? What if something happens in between? Because life does happen, and it will impact your business, it impacts your family, it impacts your cash flow, right? And there are certain aspects that we have not spoken about because we only have an hour, right? So guess what? Reach out to your professional advisor, whether it be your lawyer, your accountant, your insurance agent. Talk to everybody so you have a full understanding of what your options are, understand what your goals are, because that's ultimately the most important thing, what your wishes would be, how you want things to play out, and you plan accordingly. So it's congruent, right? And everybody's on the same page. Know that life changes. As you said, Miriam, marriages, divorce, illness, just changing in goals. Everybody changes. Make sure as changes occur, you make adjustments as necessary.
Yes, absolutely.
Right? So thank you all for your contributions. Are there any questions among the group here? So one thing I wanted to say, right, because from an insurance perspective, what I love about the funding options available is that, again, it can change with you. In the initial stages, cash might be tight, right? Purse straps are pulled tight. There are people who are dependent on you, and there's not much of a buffer that you have available in your life. Insurance is there, and affordable insurance, right? Building those safeguards. When you've built up something that can provide for you, you have those reserves, guess what? You can change it now to become not just a protection tool, but also a wealth building tool, right? And then in the future, for expansion, for passive income, you can leverage that asset as well, right? So use the tools that are available to you. Make the efforts to understand them, right? So you can leverage them properly as you go through the different phases of your life.
Right, absolutely.
Absolutely, yes, agree.
All right, ladies, thank you so much. How can individuals who might be watching, whether live or later on, how can they get in touch with you?
Miriam, do you want to go?
Sure. So you can get in touch with me on my website, venturehouselegal.ca. You can book a free discovery call and we can go from there. It's a little meet and greet to see what we can do to help you out. So there's that, or you can also reach me via email, info@venturehouselegal.com. Excuse me, .ca. I always get that mixed up sometimes.
That's okay.
And
Claudia?
for myself, so you could do either a call, phone number is just down there on the screen, 647-460-3364, email connect@chppc.com, or on my website, you can actually email directly from there as well. And happy to chat with you. I mean, any intro consultancy, of course, is a free initial consultancy. So really looking forward to talk to people and how we can make a difference.
All right, thank you so much. And if you want to reach out to me to see how you can protect your business, protect your family, I'm available by email, info@moneymattersca.com, or reach out to me 647-951-6905. All three of us are here to help. Thank you so much for listening.
Thank you.
That was awesome. Thanks.